Hello and welcome to the First Brick Property Podcast, episode
24.
My name is Kay. I'm the director of First Brick Property Buyers Agency, and the purpose of this podcast is to bring a casual show to discuss all things property, with education being the key. Whether you're a beginner or a seasoned investor, this show will be able to further your knowledge and really remove any barriers to getting involved in the exciting and fun world of property. So, before we get into the episode today, and before I introduce my co-host or my guest, I'd like to apologize for the 2-week delay in this episode. I did have a little bit of an incident at soccer last week. I copped a bit of a knock to my ribs, and pretty much borderline, if it was a little bit harder, I would have cracked my ribs. So the last week and a bit, we've been having a little struggle with breathing. So we thought it might not be the best episode if I was trying to, I was wheezing and stuff. People might think I had COVID or something. So we apologize for having that episode delayed, but we do have a fantastic episode lined up today. Before we get into it, let me introduce my guest today. His name is Bishoy Wasif. He's been on the podcast before. Bishoy, welcome.
Yes.
How are you?
I'm good, man. Thanks for having me. You know what they say, though? Good things take time. So you're away for 2 weeks, but keep the readers interested. So we've got a really good podcast happening today.
I think so too. I am still struggling a little bit to breathe because of the cracked rib and the inflammation around the lungs. But hopefully it doesn't come out in the recording. Hopefully people can't hear me. And this partially why we're not video recording as well today is, I don't want people to see me clutching for air.
Yeah, that's fair. We also got that 1.5 meter distance between us.
We are definitely distanced. For social distancing reasons. You've been on once before or twice?
I believe it was once.
Once before. This is your second time.
Yeah, this will be my second time. I get excited when I get in your podcast, and I feel privileged.
I only asked you to come on 12 weeks ago. It just took you a little bit of time.
Like I said,
you're a busy man.
Like I said, good things take time. I really believe listeners will really enjoy what we're going to discuss today, but I'll let you sort of introduce
Well, before we get into it, do you want to tell everyone what you do and where you're from and etc.?
Yeah, so I am an accountant by trade. I also have a mortgage broking business on the side that I assist people with. I did at some point get into law. Being WOG in nature, my parents always wanted to become a lawyer. I tried that. Didn't really feel it. I decided that accounting was my bread and butter. So accounting and mortgage broking go hand in hand.
Yeah.
So since then, I haven't looked back and
are you enjoying this route, or would you have rather been a lawyer?
No, I definitely enjoy this route. I think law is not like what we see in the movies.
It's not like Suits.
No, definitely not. I wish it was, but unfortunately it's not. So it's a lot more heavy based and long hours. I like my freedom. I like my balance. So I'm all about work-life balance. For
sure. So you're obviously a mortgage broker. So today we're going to discuss. Our topic will be around the mortgage brokering and lending side of things.
Yeah.
Last time you were on, I do believe we spoke about lending as well. This time it's going to be a little bit of a different discussion, maybe a bit more process driven, and I think it's going to bring a lot of benefit to the listeners in terms of they will understand how the banks are thinking. And if you understand how the banks are thinking, everything starts to make sense. You start understanding why they want certain things and why you're trying to do certain things. And you can actually figure out how to move on forwards. I always say that real estate or building a property portfolio is actually a game of finance. It's not a game of bricks and mortar. So if your broker or if your financing isn't done correctly, you can ruin your chances of building a portfolio. Whereas if you have a good broker, a very savvy broker that understands the game and understands how to get your financing in order, is going to really set you up for subsequent purchases, which is very important when we're trying to build a portfolio. Where we're going to talk about servicing and things like that. So I think it's a very good topic we have today, and one will bring a lot of benefit. Before we get into the servicing and how the banks work and stuff, let's discuss. I know you've brought in some myths or misconceptions, So let's discuss some misconceptions that a lot of people have. I'm sure you get asked these questions all the time. Let's go through some of these misconceptions that people might have of the banking or the lending world. So do you want to hit it?
Yeah. So when I was writing this up, I was thinking practical questions that I always get asked by my clients of what's happening here, how do we do this, and some sort of myth. So the first one that most brokers get and what customer or clients always ask is, can you only have one loan at a time?
Yeah.
Now, on the face of it, this misconception is one of the most understandable ones, as you can see. While it is up to each individual lender whether they would want to issue you with a new loan, it depends again on whether or not you have the ability to service a second loan or a third loan. So if your income is higher or you've got low levels of debt, then there isn't anything stopping you from having more than one loan at a time. And that's where the idea of people having 11, 12 properties and using equity to purchase these properties. And people wondering, well, how? Well, it comes back to what we'll discuss later, which is the serviceability process, but along with nothing stopping you from having those multiple loans. It all depends on, number one, the lender and your current situation.
Yeah. So I guess an extension of that point, you can only have one loan at a time, is you can have 5 loans with 5 different lenders.
Yeah.
And you can have 5 loans with the same lender. You can have 5 loans with 2 lenders. So there's no rule regarding who your finance is with. And because I'm sure, you know this more than me. For example, we've got the big 4 banks and I'm trying to get a loan. One bank may not give me anything. And then the other 3 banks may say, no, we'll give you some money. So if one bank says no, it doesn't mean it's a no. It just means that you haven't met their criteria, but another bank might have a different criteria.
Yeah, that's right. It also comes down to industries as well. So certain banks, like you touched on that earlier, which was the top 4, they tend to provide medicos with a lot more benefit when it comes to 90% and how they assess the overtime and all the other income stream that comes from. Because in being in a medico or being in a certain industry, not necessarily just medicos, you do a lot of overtime, you get a lot of commissions or sales rep industries, or we work at a car dealership, you get bonuses and commissions, and each lender assesses each of that separately, same as rental income.
Yeah.
Each lender assesses it differently.
They have different criteria.
Yeah, different criteria. So you're right in saying that you can meet the criteria of one lender, but then don't meet any other. So it comes down to your discussion with either your broker, who, again, what you were saying earlier, depending on how savvy your broker is, you'll be able to assist you in that process.
Yeah, for sure. Can you explain, because you just touched on it, we were speaking about medico. I know, for example, people in the medical profession and other professions like chartered accountants, lawyers, stuff like that, they can access up to 90% without LMI.
Yeah.
Is that true? And can you explain what the process is if I'm a medical professional or something like that? What do you...
So generally speaking, in certain lenders, the policy has changed recently. But overall, right now, most lenders that have made it the top 4 lenders, they're offering 90% for LVR without any insurance. What that means is if you buy a property for $1 million, if you're in those industries, so you're right, chartered accountants earning more than a specific amount, a medico, podiatry has recently joined that list in certain lenders as well. They allow you to borrow up to 90%, which means $900,000.
Yeah.
Now,
you only need half the deposit.
You only need half the deposit.
That you would usually need.
Yeah, so usually a normal person would need 20%.
And why is that? Why did I get special treatment?
It depends on the industry, realistically.
Yeah.
So the income tends to increase as time goes on, and it's seen in case by every case, generally. And also the fact that, and it's going to sound a bit strange, but banks look at the industry as secure. People are always going to need a doctor.
Yeah, their job is safe.
Yeah, it's a lot more safer than the average job.
And the incomes are usually growing, like you said. Yeah. So I guess from the bank's point of view, these people in these professions, they're low risk.
Yeah.
So they don't mind lending a little bit more. Yeah. Whereas if I was a fly in, fly out, or if I was a contractor, I wouldn't be able to get a 90% because they don't know where my next paycheck's coming from. Yeah,
so well, again, it depends on, you're touching on it, but we don't want to get mistaken with, you can be a locum, for example, a doctor, and you're essentially similar to a contract.
Fair enough.
Basis. Yeah. So but if you're like contracting a specific industry other than the medicos or that fall in that list, then you're right.
Yeah.
It's not as secure because you're living paycheck by paycheck or there's no consistency in income.
Yeah, cool. All right, let's move on to your second myth that you have there.
Yeah, the second one, which I get a lot, is if you have bad credit, you won't be able to get a loan.
Yeah.
Now, I know it sounds cliche and but that's incorrect because it comes back to, again, why do you have bad credit? what was the reason behind your... So you obviously, the better your credit history, the better it is for you. There's no denying it. But in saying that, just because you have a bad history, that won't automatically mean you get declined. Lenders do see this, and they will assess if you've ever been bankrupted, defaulted, or you miss a couple of payments. But generally speaking, if there's a reason behind it, then they will just ask for the reasoning. So when they go through the process of assessing the loan, they actually do a credit report history. So they check what's happened, and then they ask the broker or they ask the customer directly, depending on how the customer went to apply for the loan, and say, well, what happened here?
Yeah.
What happened there? What happened there? So, and if you can give an understanding, my ID got taken from you, or I needed a loan ASAP and I need to get a personal loan real quick. If you can give them an understanding or logical reason behind what happened, and there's an actual justified reason, then it won't impact you. Yeah. In saying that, if you have 15 inquiries or 16 inquiries in 2 days or 3 days, and you can't justify it, then from that instance, yes, it would impact you negatively. So it just comes back to what was happening in that situation. In every case, it assessed differently.
Yeah. So the banks are not just looking at it and saying, you missed a payment here one time 18 years ago. Sorry, mate, no loan for you. They'll go into it and they'll say, why did you miss that payment? What was the situation? So it is very personalized in that situation. I did actually just have a client that we just worked on, and he was very worried because when he was much younger in his late teens, he used to buy a lot of cars, he was a car enthusiast, and got a bit of a bad credit because he didn't really understand what he was doing, and he got really worried that he wasn't going to be able to get a loan. But it was a very simple process. It was like 10 years or more than 10 years ago, and the bank kind of just didn't even look at it. They said, well, it's so long ago, we're not stressed about it. So,
yeah, we also need to, and I think a lot of clients actually don't realize this. When you go get a new phone contract, let's say you get a Vodafone and you get they actually do a credit inquiry.
Yeah.
So generally speaking, anything that relates to a credit, you'll get an inquiry as long as you give them authority. So don't think if you went to get a phone contract and you sign in that's it, you don't have a credit inquiry. No, you do. So I know a lot of customers, I'll get them, or clients, I'll give them a loan and the bank would ask, what happened with this Vodafone, for example? What happened with this car loan? And people are like, I didn't know there was actually a credit inquiry. Yeah, no, that's why I need people to remember that there is always, if you do take anything relating to credit out, there will be an inquiry. Unless you specifically say you don't want to take it out at the time when you go to that lender or that let's say Vodafone or that dealer, then that's fine.
Yep.
Yeah.
Okay. Moving on to myth number 3.
Number 3, borrowing more than you need. Now, what does that mean? Generally speaking, depending on the situation you're in and depending on the circumstances, having more in savings or in offset is always generally, from a high level, is a good thing to have.
Yeah.
But in saying that, it's not necessarily the best thing to have as well. It depends in the situation, depending on the time. So while there may not be a problem in applying for a $500,000 loan if you only really need $450,000, we should always be careful about the following. Why do we need the additional, let's say $50,000 for? What is the difference between the $450,000 payment and the $5,000 loan?
Yeah.
How much more will we be paying in total if we've changed the repayment period? Can we actually afford those extra repayments on a higher figure? And is there a fee or a penalty for early repayments? And does repaying early actually save you anything at all? These questions we really need to think about when we borrow more than we need. Generally speaking, if you have an offset account, it works counterintuitive because you're not actually paying any more interest.
Yeah.
However, we still need to think of those other questions. Can we actually physically budget for it? Can we make the extra repayments? Mm-hmm. There's other factors that need to take place. So it's not a bad thing if you want to borrow more than you should, but you just need to think of your situation, speak to your broker or the bank if you're going directly to the bank and finding out what's best for you at the time.
So you're talking about in this point, you're talking about if I can only really afford 450, I mean obviously I can afford 500 because the bank will give it to me, but 450 I'm comfortable, 500 I'm pushing my expenses. Yeah. You're talking about in this situation, it's not good to go to the 500 mark.
Yeah.
But you're not talking about the actual application because there's no, like if I know that 450 is my price point and then I put my application through and I tell you, Bishoy, just give me the most I can get and then I'll decide after. There's no problem if you come back and say, look, the bank's going to give you 550. Yeah. There's no issue in terms of the application.
So if you go through the application process and your broker says, hey, look, I think we can actually get you 650, let's just apply for 650, for example.
Yeah.
that's fine. As long as when the bank looks at it, like, here's a pre-approval, for example, for 650. If you choose not to use a 650 and go within your means, for example, say 550 is your means, that's totally fine. So it's got nothing to do with the process of applying. It's more when you get the loan, what's the best in your situation.
Yeah, for sure. Because that's something we do with our customers. Obviously, it's because we send some to you. When they come to us, if they don't have finance, the first thing we tell them is go get finance. And I always tell them, and I've communicated with you on multiple times through the clients, saying, just tell me how much they can get, what's the max, and then we'll budget and we'll work it out what they can actually afford to buy.
Yeah, of course.
So, there are times you come back, they've got a loan or pre-approval for up to $100,000 purchase, whatever, and we only end up buying at 600 or 550 or 650 because based on where their future and their financial goals and the future purchases are, we've figured out that if we buy the 800, we can't actually go to step 2, 3, and 4. But in terms of actually applying for as much as you can, there's no issue.
No, there is no issue because it ends up being under the same inquiry. If you borrow 800,000, you end up buying for 600. It's still going to be an inquiry regardless of how.
And if we were looking to buy at 600 and then we put in the application, whatever, for 800, and the bank came back and said, sorry, only 750, well, you're still 150 above where you thought.
I definitely agree. Again, with me and you have dealt with numerous times. It comes back to if it's an owner-occupied or investment and what your budget is and all that. But generally speaking, applying for your max is not necessarily a bad thing. At least it gives you a ground to.
Just depends on what you do with it.
Exactly. For sure. I agree with that.
All right, well, let's move on to myth number 4.
Which is what you touched on before, which you need a 20% deposit to buy a property.
Yeah.
Now, that's true maybe 50 years ago.
Yeah.
But you can actually obtain a property with a deposit of as little as 5%. I know we spoke about the first home loan deposit scheme in our last chat, actually. And that still applies for first home buyers. But if you're not a first home buyer, it doesn't necessarily mean you only still need a 20% deposit. There's other ways of getting a loan without having a savings of 20%. Along the lines of you can use a family guarantor. So I know I've done with a couple of clients a bit of a security guarantor that we use a parent's property as a guarantor to assist them to purchase. Along with, if you're in America, you really need 10%. So that's a misconception we all have that we need to remember that you actually don't need 20%. And let's say, for example, your situation arises and you don't have a family guarantor, you're not America, and you need to purchase a property, and you only have a 10% deposit. Taking out something called lender's mortgage insurance is not always bad in this situation. People look at it as dead money. Well, it's technically, it is dead money. But at the same time, I know you're a big believer for it if it helps you grow. So I'm going to let you go with your point. But I think from my perspective, it is, if your property grows in that period of time, then you're not physically paying that LMI insurance. It just helps you purchase your first property to buy a second and your third and fourth. But I'll let you, because you look at me like, I want to give it a say.
No, well, I'm just going to, I think we've touched on this before on the pod, saying that our belief around LMI is, look, if you can avoid it, avoid it. But if you cannot avoid it, embrace it, because the LMI is getting capitalized over the life of the loan anyway. So it works out to be quite a small figure. And if the market's moving way quicker than you can save, and this is going to help you get into that market and, grow equity and, and move your portfolio across, then LMI is definitely something that we would look at embracing and not really stressing about, to be honest, because it's going to be capitalized through the loan anyway, so it doesn't work out to be too much. In the situation where you can save quicker than the market is moving, or you can avoid LMI, obviously, in that situation, avoid the LMI. In terms of the 20% deposit, 20% is the norm, like the safe. You've got 20, there's not going to really be too many issues when it comes to the deposit side of the loan. I know if you have less than 20, like with off the plan and house and land packages and new builds, the valuations are much more tricky because the bank doesn't have the risk appetite to take on a 90% loan or 95% loan on something that hasn't been built yet. So those ones get treated a bit differently. But correct, in the normal sense, a 20% deposit isn't required, and that is a big myth. And a lot of people can probably enter the market quicker than they thought if they knew that one.
Yeah, it also gives you freedom to, like you're saying, touch on what you're saying there. Like, it's all about opportunity costs. If you forego the opportunity to buy a house now and wait to have a 20% deposit, not realizing there's other ways of getting that house now, then the long term you might actually slow down your financial freedom goals. So it also comes down to your own budget, your own appetite, your broker, your bank, whoever you're speaking to assist you, your financial advisor. A real discussion you'd have with them.
When we sit down with our clients and do property strategies and we forecast where we want to be, and a lot of the time they're thinking, oh, maybe I'll start next year or the year after, and I mean they don't actually realize the quicker they start or the earlier they get in, like every year is a fundamentally like a huge dollar figure difference for every 10 years, for example. So if I start today as opposed to today next year, that 1 year difference when we look at 10 years time, the compound interest and the growth on that is huge. We're talking huge money, about hundreds of thousands of dollars, big dollars just for every single year early. So if it means you're going to get into the market early and you got to use LMI or use a smaller loan, whatever, a deposit, then something to consider for sure.
Yeah.
We'll move on to your fifth myth regarding this.
Yeah, this is the final one. People always ask me this question. Should I pay monthly? Should I pay fortnightly? Should I pay weekly?
Yeah.
Now, people think that paying monthly is the same as essentially paying fortnightly, but that's actually incorrect completely. If you use, for example, a $350,000 loan on let's say a 4% interest rate. I know it's a bit higher these days given the market rate, but let's just use prime facts of this thing, 4%. It would roughly mean a repayment of about $1,800 per month.
A month. Yeah.
Now, if you pay half that, it's about $900 per month, per fortnight. The loan term would actually be 25 years and 6 months if you do it on a fortnightly basis. Yeah. Because you're making extra payments and you're paying off the interest a lot quicker than if you were to do it on a 12. Instead of making 12 payments, you're making 26 payments. It would be even better if you actually went weekly as well. But again, depending on people's situation, like for example, me personally, I get paid on a monthly basis. So from my cash flow perspective, it's a lot safer for me to do it on a monthly basis. What I've recently changed it to a fortnightly basis because I'm trying to pay off my loan quicker. But I know other people that say, look, no, I'd rather just direct debit it once a month with the rest of my expenses. I'm too busy trying to figure out these. I don't have time to go do it myself. Let's just do it that way. So again, it depends on your situation, but that's a big misconception. One of the main misconceptions people have saying, oh, it's the same repayment over life loan. Well, no, it's really not. Yeah.
I'm actually working on a little bit of content at the moment, trying to make a video and some content for our listeners and viewers of the page. And it's pretty much called the lazy tax. Because you're correct. Simply changing your loan from a monthly to a fortnightly repayment will save you a lot of money. And a lot of time off your loan as well. And then obviously if you go down to weekly, you're saving the monthly repayment and the fortnightly repayment. You can't actually just half it because obviously the interest is accumulated. And when you've made your fortnightly repayment, your interest has gone down. So the next fortnightly repayment will be lower as well. So definitely it's, and most people kind of just leave it as the monthly repayment because it's just, like you said, it's easy. It's, when it's coming out once a month. But that's why we call it the lazy tax because you're literally giving the bank a bit more money for absolutely no reason.
Yeah, no, I agree with that. Well, those are my 5 misconceptions, and I'm sure there's other myths that people may have, and I'm sure if they really want answers to their thoughts or if they think that their thought process is correct, feel free to drop a line to you or me, and I'm happy to answer any questions they've got regarding any myths they may have by purchasing a property.
Yeah, for sure. So we'll move on to the second part of the show. And this I think is really, really cool because we'll be able to see how the banks look and think about us when we're trying to apply for a loan. And something that we have to remember is it is actually a privilege to be able to borrow money because we are borrowing money. There is no obligation for the bank to give me money. They don't know me. They don't really care about me. There is no obligation. It's their money. So you do have to meet their criteria. And sometimes their criteria may not make sense in your mind. But they're the ones giving you money and taking risk on you. So it is actually a privilege. So we'll go through the way the bank thinks, I guess, in terms of getting a loan and serviceability. And it might help us when we're looking in the future to borrow money. So where do you want to start this at?
Look, I want to start with the question. We we ask ourselves, we'll look at a financial situation, or we speak to friends, or we speak to our broker or a bank, and we say, oh, look, I make all my repayments on time. I save $1,000 per month. Why is the bank telling me I can't service a loan?
Yeah.
Now, before we get into the processes, so to speak, we need to understand the disclaimer is different lenders have different credit policies.
Yeah.
And what we're going to go through now is essentially just an average or the guide to be using. But you need to.
This is not gospel.
Yeah, this is not gospel.
Just a general guide.
Yeah, you would need to speak to your bank directly or your broker, whoever you deal with, to go through in a bit more detail. But it's just to give you an understanding of just a general overview of what you need to be thinking about when you do apply for a loan. So, like I said earlier, lenders based on different factors, including your income, what you're looking to borrow, where you live, your other commitments, and any expenses you have. So the first one I thought we could go through is living expenses.
Yeah.
Also known as the bank's mind is called HEM.
Yeah.
Now, even though your living expenses may be low, you may say, oh, we budget for $1,500 per month, for example. And you say, and you can show that you only have $1,500 per month of expenses. The bank doesn't assess it on what you believe it is. They actually assess on something called HEM. And it's pretty much, HEM is calculated based on a couple of factors. One, your income, how much money you're making. 2, where you live. 3, if you're married, if you're in de facto, if you're single. And 4, if you have any kids. Now, every one of these factors play a role in how much they calculate your HEM. So we can have 2 people earn the same amount. One's married, one's not. One's living expenses higher than the other.
Yeah.
Or one lives in a certain area and one doesn't. Her living expenses are a lot higher than the other. So, and this is something you actually can't go around. You can't, even if you can prove to the bank your living expenses are lower, they will still assess on their calculator at their HEM version.
So the HEM is essentially the bank's, the bank's idea of what the minimum living costs are for your situation.
Yeah, exactly.
So I might spend only $1,500 a month, like you say, but the bank says, no, for someone in your situation, the typical lowest living expenses to live and be comfortable is $2,000 a month. So they take it as $2,000 a month.
Yeah.
Okay. So even if you're, and in the situation where my costs are higher than the HEM, obviously they take the higher cost.
Yeah. So if your living expenses are higher than what HEM is, they will take the higher one. HEM is just I would like to say the lowest.
The lowest it can be.
Yeah.
Okay. Now, moving on. Next
one is credit cards and other debts. We look at it and we're like, oh, well, I've got nothing on my credit card. I've got a credit card, but I've got a limit of $6,000. But I don't actually use it. It's just there, just in case. We need to understand that the banks actually take this into consideration, regardless if you used it, regardless of the amount owing on it. They will actually times the percentage of your credit limit to be your monthly repayment. So most banks average out 3%. So at 3% of, let's say, $6,000, the bank will assess you $180 per month.
You always owe.
That you always owe.
So that gets added, does that get added to your, expenses?
Look at your expenses, your ongoing debts, that reduces your borrowing capacity, I would say. And then people say, well, and I've come some clients that have $50,000 credit cards, and that plays.
So obviously,
it becomes in the hundreds and the thousands even. And so you not using your card actually doesn't stop you anything. Same thing another misconception people have is HEX. Now HEX, unfortunately, is like ongoing debt. You don't physically see it at times. But in saying that, it's still assessed from a serviceability perspective the same way the ATO will assess it. Now, if your income is lower than the threshold that the ATO has, then the bank won't assess it. But if you earn more than, let's say, $58,000, then the bank will assess your HEX at usually at 8% per month. So if you have $30,000 owing, they'll times that by 8%, and divide that by
12.
Yeah, for the monthly repayment, and that's what your repayment would be.
Yeah.
They also sometimes just, if it's on your payslip, because you might already click yes, I have a HEX there.
It might be coming out already.
It might already, and they'll take that into consideration as well.
Yeah.
So we also need to remember that actually plays a big factor. Another thought process with this is your offset account. People say, well, let's say they've got a $700,000 existing loan and they've got $300,000 in your offset account. People come to me and say, well, I only have $400,000 loan. Well, no, the bank still says you're on a $700,000 loan, even though you may have $300,000 saved.
Yeah.
Because the bank look at it as, well, you can take that money out at any point in time. Now, if you put that 300,000 into the loan, then that's a completely different story. Then you do have 400,000 because it's very hard you take it out. You have to go through.
But then you don't have $300,000.
But then you don't have $300,000. Yeah.
Right. Before you move on, I did want to I thought about this when you were going through the myths. I forgot to mention it regarding credit cards. I don't know if you get this a lot, but I definitely see it. I would assume you do. Is one big myth is I should have a credit card to prove I have a good credit score. So from my understanding and my point of view, like you mentioned, that's sort of irrelevant, that part, because if you have a stable job, stable income, you can service and everything else ticks, they don't really care if you've had a credit card or not in the past. And in fact, as we've now learned, the credit card will be a detriment to servicing because they're going to take 3% at the minimum of whatever your credit card limit is as more debt, especially if I don't use my credit card. So if I have a $10,000 credit card and they're saying because of you have this credit card, you're going to owe $300 per month extra, and that means I'm $300 short in servicing, and I'm not using my credit card anyway, you just close it. Would be the smart thing to do. So
that's right.
A lot of people, they think I should get a credit card to prove that I'm good at making repayments.
Look, and that's a misconception as well. I think you touched on it before. If you have a decent job, steady flow of savings is a big show up for credit as well. If you got decent savings, the bank sees it as, okay, this guy has the ability to show genuine savings. That would actually be a better way of proving to the bank that you can borrow without the risk of detrimenting your borrowing capacity. So you're right in that point. All
right, we'll move on to the next one.
The next one is income. People say, well, I make $180,000 a year. But it depends on how much. Is that your ordinary income? Is that overtime? Is that bonuses? Is there commissions? Is that allowances? Every single type of income stream is assessed differently. Are you a full-timer? Are you a casual? Usually the consensus is your normal job, your salary, your ordinary earnings. That's assessed 100%. They're taken into consideration. However, they do obviously take a tax calculation for it in their own serviceability calculator. As normal. Overtime, commissions and bonuses, they're assessed very differently with different lenders. Most recently, I actually had a client who makes a lot of their money from commissions and bonuses because he works at a car dealership. And the bank came back and said because of COVID, they've actually they shaded it from being 80% that they'll take into consideration to 60%. So what that means is, instead, let's say you make $100,000 a year in bonuses, the bank would have assessed 80% of that, which is $80,000 as normal
as income
to part of your serviceability. Now they're actually taking only $60,000.
Yeah, wow. So the type of income
plays a big factor.
Looks different. So if you can, so $100,000 as a salary as opposed to $100,000 in commission, you're looking at $100,000 versus $60,000 in the eyes of the bank.
In the eyes of the bank. Yeah. Again, it also comes back to how consistent is that money coming through.
So because obviously commission isn't. I can see you cannot forecast commission every month because obviously the nature of commission is that it's based on performance and stuff, whereas your salary it's the same.
You've got a contract. Your employment is you're making this amount, this hours you're working, this is your salary, and the banks will take that into consideration. When it comes to bonuses and overtime, they look at the last couple of pay slips. They might look at the year before if it's a bonus to see how consistent you are getting the bonus. When it comes to overtime, they look at the last 3 months and see annualize and say, okay, well, they've worked this amount of time. This is what their ordinary earnings is. This is the extra money they made from overtime. We're going to separate them. We're going to use 100% of the ordinary earnings and 80% or 60%, depending on the lender, of overtime. Another idea we need to remember from income is what type of work you're doing. So are you a full-timer? Are you a permanent part-timer? Are you a casual? Now, usually a full-timer and permanent part-timer, you don't need to show a history of working, generally. You just need to show an employment contract. If that's your first job, an employment contract and the first payslip generally is enough. If you're a casual, you actually, majority consider you need to be working 6 months in that industry or in that role. That's a big one.
And what if you're self-employed or you run your own business?
Usually it's 2 years. You need to show financial attachments for 2 years, but again, it's based on the lender and the credit signing off, but generally you should be able to get you can get over 2 years, but most of the time you get over 12 months.
Okay, so if you're a new business, you've only been in operation for 6 months, for example, it's going to be very hard to borrow against 6 months worth of financials. For the obvious reason, it's a new business and no one knows where it's going.
Again, it comes back to full doc and low doc, and some lenders will offer you on a less requirements, but your rates are going to be a lot higher. So if you're a person who's not going to be too rate sensitive, you need that loan, then you may potentially go low doc.
Yeah.
If you're a person that's very rate sensitive and your income you believe is consistent and you can wait 6 months or for a year and then you can see it.
Yeah.
And also, so it depends on your situation and what your appetite is.
Yeah. So, I mean, I feel like that's pretty straightforward in terms of a reasoning point of view, like quite logical. I mean, if you are looking to get a loan and I'm full-time, I mean, it's pretty easy to show you where my money is going to come from. Whereas if I own my own business, as I do, for example, and I've only been in business, for example, 3 months, I can't go to the bank and tell them, in 3 months I made 100 grand. I'm going to make 100 grand every 3 months. They can't forecast that. It's hard for them to predict it, so it's hard to lend against it. So quite straightforward.
Yeah, I've also had, that's right. I've also had clients where they'll be doing 6 months PAYG, so they're employed by someone else, and then they end up getting an ABN and self-employed for the next 6 months. Now, if it's in the same industry, again, it depends on the lender, depends on the credit, you can tend to get that argued that your income will be consistent because you've worked in the industry before, regardless you weren't self-employed, you were PAYG. So again, it's case by case.
Yeah, it's case by case.
Case by case basis, but
these are the general
consensus.
Right. Moving on.
Yeah, but before that, I just want to add on a small other point. Centrelink payments. Especially these days now, a lot of people are getting Centrelink payments and a couple of other benefits. Some benefits are actually taken into consideration for serviceability. So family benefits or pensions, if they're long term, can actually be used for serviceability as well. So given the situation right now with COVID and everyone getting benefits, people thinking, well, I can't get a loan. Well, not necessarily. You should definitely speak to your lender or your broker, and they'll be able to tell you which Centrelink payments that you receive, whether you are eligible to be used for serviceability. The next one actually is rental income. Now, people look at it and be like, I can rent this house for $500 per week, for example. And then people are like, okay, that's $2,000 per month extra that I can use for my serviceability. Well, not necessarily. Some banks use 70% and some banks use 80%. There's not many banks that would ever use 100% because they always try to have a buffer for expenses.
Expenses, vacancies.
Yeah, so they usually say 20% or 30% is usually the expenses side of it. So you have management fees, you have council rates, you have water rates, you have period of time where it's vacant, you're not renting it out. All these factors are taken into consideration to assist the bank there in a worst case, because you also need to look at it, the bank looks at it in a worst case scenario.
Yeah.
And that's why they have buffers and they take less income. Can this guy, for responsible lending purposes, make the repayment on this loan? And they need to be sure they do their own checks as well.
Yeah.
Because some lenders previously got into trouble by being a bit more discretionary and not realising having a bit more stricter tests. So as much as we don't like them,
because obviously if something goes wrong and in that worst case you can't pay your loan, obviously you will lose the house. And it's not a good look for you and it's not a good look for the bank. So they want to obviously avoid that.
Yeah.
In terms of the rental income, so that's obviously if I have an investment property already, I can show you I've got this. If I'm buying an investment property, do they forecast rent as well?
Yeah. So if you're buying an investment property, they'll tend to ask for you to give them a rental appraisal.
Yeah.
And then they'll compare that rental appraisal to the valuation that they get, because on the valuation report, it would also include an expected rent.
Yeah.
And they tend to use the lower of the two.
Okay.
So if your expected rent on your valuation report is a lot lower than your rent appraisal, they'll take the valuation report, vice versa.
And then they go and take the 80% of that.
80% or 70%, depending on lender. They also take into consideration negative gearing, which also is a benefit for you. So people think, if it's just the income that gets taken into consideration. No, it's actually negative gearing, which will actually improve because they add back all the interest you would have paid essentially as income because it's deductible. So it's a bit more of it's not as easy just whatever your interest is to divide that by 12 and add it back. It's not like that. There's more of an actual calculation. It'll take it post-tax as well and a couple of factors. But generally speaking, negative gearing is taken into consideration as an income benefit for you.
Yeah.
From a serviceability perspective.
Yeah.
The next one is the assessment rate. Now, I think this is the main one people always get confused about, and it comes back to my initial question. People are like, well, I'm saving $1,000. Why can't you give me a loan? Well, so people might look at it and say, well, my repayment, they get a loan, let's say $500,000, and the broker tells them their repayments, or the lender tells them their repayments is $2,000 per month. So they calculate it as every other human would be. My income is A, my expenses is B, my other expenses is C, so then it equals, I have a budget of D. So I've got a positive or a negative, depending.
Yeah.
In this situation, let's say they think they have a positive, that they should be able to get that loan. That's right on a day-to-day sort of transaction budget, what you do for yourself. But from the bank's perspective, they actually put a buffer on it.
Yeah.
Because the rates today might not necessarily be the rates in 10 years or 20 years,
Yeah.
or 30. And you have the loan for 30 years. They don't anticipate that you're going to refinance.
Yeah.
They assess you on the next 30 years.
You need to be able to make repayments if the interest rate goes up.
Yeah. So they assess you on if the rates go up to a certain amount.
Yeah.
Can you still make the repayment?
And is that usually 2.5% on top of?
Yeah, it tends to be 2.5% on top of what your existing current rate is.
Yeah.
It's usually now it's like some banks are having a ceiling of 5.5, 5.75 as the
Minimum?
minimum assessment rate, and they'll assess you on that.
Okay, so if the interest rate right now is, for example, 2%, and they add 2.5, that'll be 4.5.
Yeah.
They'll still use the 5.5.
Yeah, because banks use, and this is the thing we need to understand is banks don't. If you go let's say you go to a bank and you get a pricing approval, and your rate is lower than the original, the base rate. The bank actually takes the base rate. They don't take what you've been approved on. So let's say, for best example recently is there's some lenders offering 2.19 fixed and occupied for 2 years, for example. And people say that, okay, well, that's what they're going to assess me on. Well, no, they're going to assess you on the base rate, which is 2.49.
Yeah.
So you're going to do 2.49 plus the 2.5 or the 3%.
Yeah.
And that's how they do it. So we need to remember it's always on the base rate.
So if someone at home is trying to work out their own, forecasting and predictions, when they'll just work on a 5.5%.
I would usually work on a 5.5.
And if you can service it at 5.5, you'll obviously be able to service it at 2.5, and have plenty of cash left over.
Yeah, so from your own perspective, you can say, okay, I can do it for my personal understanding.
Because you want to see your own buffers as well.
And you obviously want to assess your situation before you submit to a bank and have them tell you no, sort of thing.
Interest rates will not change for a long, long time. And we'll probably never see 5% in our own lifetimes, but I understand the rates are coming
it's just,
from,
who knows?
Who knows?
The rates will
That's
come
right.
down to this in this market.
Who knows?
So again, I agree with you. I don't think they will go up to that level, but who knows?
Yeah.
The next one that we need to keep in mind is interest only versus P&I. So people think, well, interest only, my repayments are less, so therefore the bank should assess me my repayments as being less, so therefore I should be able to borrow more. I have a lot of clients ask me, well, if I go interest only, does that mean I can borrow more? It actually works the opposite. Because the bank assesses a loan term over 30 years. So if you just say you got interest only for 2 years, the bank says, okay, he's got interest only for 2 years, but now he's going to make all the repayments
in 28.
P&I over 28 years.
You got less time to pay the same
off
amount.
the full amount. So therefore, you would rather it be over 30 years than over 28 years. You have 2 extra years to make the repayment. So if you do it, let's say you have interest only for 2 years, the bank will be like, okay, perfect, but we're going to assess you over a 30-year term, not just 2 years. Therefore, your repayments are actually higher per month over the life of the loan. So I think
that it impacts your servicing.
Yeah.
But like, for example, interest only, like a lot of my loans are interest only. So it does help with cash flow. It just depends on what stage you are in your property acquisition. If you're in property acquisition or if you're in debt repayment, whatever phase you are in your property journey, interest only or P&I will be different, used differently for different reasons. But in terms of servicing, interest only, obviously they will look at it because you've got less period of time to make the same repayments. Your loan will have to go down.
Yeah, like again, these ideas are how the bank says. Right or wrong. Again, you're right. It depends on your current situation, your strategy, what you're trying to achieve. I have a lot of clients that they have, let's say, have an investment on occupied, and they realize, look, I'd rather pay my occupied quicker because that interest is not deductible, for example. So they're going straight on investment on P&I on an occupied.
Yeah.
So again, you're right. It depends on your situation and your strategy, but this is just how the bank looks at it and how they assess it. So when you're looking at getting your loan, I want you to be like, okay, this is what I need to remember. But it doesn't mean you have to just keep a P&I for the sake of borrowing more. It just depends on your situation.
Yeah.
Another one that is not necessarily in your control, so to speak, but it's about something called debt servicing ratio. So what it is pretty much it calculates what your percentage of income applied towards your debt. So if you earn a lot of money, let's say you earn thousands or hundreds of thousands of dollars, but your debt's low, then you're in a perfect situation. But if you got heaps of debt and your income is not growing as quick as what your debt is, then the bank will be like, okay, from a gearing perspective, there's a lot more risk here. If he loses his job, he's got a lot more chance of not being able to make the repayments on his loan. And that plays into factor into serviceability. Again, it comes back to people argue, well, how do I know if I'm going to lose my job in the future? And that's right. You don't. But the bank sort of looks at it and will take it in as a factor. It's not the deal breaker. Obviously, your income and your ability to make your repayments is a deal breaker, but they still want to assess the debt to servicing ratio. Same thing if you've got your own business, you want to know what's your assets and what your liabilities.
And what's considered like too high in terms of debt service ratio?
5.
So 5% of your income being...
No. So if your debt is 5 times more than your income,
okay, yeah,
then 5 tends to be the ratio. Now, how do you calculate it? It's a bit more difficult than that. I'm sure I can go through it now, but it may bore people a bit. But essentially, if you look at your income, look at your debt, you sort of divide them and say, okay, well, if I've got $1 million of debt, my repayments. Actually, let's not go through it. It might be here for a while. So
that's all right. We can do it on another episode.
Yeah, we'll go through it another day. Yeah. But usually if you're 5 times more, if your debt is 5 times more than your income, then that's where you got the issue.
So if someone's making 100 grand, times that by 5, that's 500 grand. So they couldn't, you say essentially a loan of 600,000 is too high.
It would tend to be too high, yes. But in saying that, for example, if you're, again, the bank looks at your serviceability and says, okay, well, a loan of 600,000, it's got $100,000 of income. It's got no other debts, it's got no HECS, no credit cards.
And then you're going to add rent and stuff.
You're going to ask rent and all that, and your borrowing capacity increases and your monthly, you're in positives, then the bank will still give it to you.
Okay. It's just one consideration.
Yeah, it's just a consideration. It's not a deal breaker, it's just the bank's consideration of this item.
All right.
And they'll tend to, and you being the customer, you probably won't see it as often because they tend to ask the broker these questions, and the broker tends to be savvy enough to provide an understanding.
You guys sort that out. So going through all of those things that the bank uses to look at if we can service a loan, if we can pay off our loan. Do you have any tips or tricks, I guess, to improve a person's ability to service their loans and be able to apply for a loan successfully?
Yeah, so you might be listening to this and after you're like, oh, I can't buy a house now. Thanks, Bish. Thanks, Cam. Appreciate I was trying to grow my career and then you guys just stress me out. That's not actually what we're trying to achieve here.
Everyone that comes through First Brick gets taken care of.
Yeah,
so.
of course.
None of my listeners are thinking that.
Yeah, I hope not. They don't know me that well, that's all. So I don't want to be the bearer of bad news. I'm not the Grinch, So I'm just here to provide advice on how the bank assesses it. Now let's go through some points of how you can actually improve your serviceability. So the main one is, which everyone I say, obviously, is increase your income. Well, thanks, Bish. I appreciate it, man. I didn't even realise that. No. What I mean by that is staying the obvious, increase your income will increase your borrowing power. Yeah. So what I mean by that is maybe go to your boss, it might be time to ask for a pay rise. Maybe not. Maybe taking a second job might actually help. Maybe getting supplementary income or passive income somewhere else, whether investment in shares, for example. Yeah. Because dividends, again, are taken into consideration our income. So I'm not saying go to your boss and say, I need a pay rise or I'm out of here. No, there's obviously other factors, but increase your income is the main way to increase your borrowing capacity.
Yeah, of course.
The next one is, another probably a pretty obvious one, is cure that credit. What does that mean by cure? I try to make it a bit more catchy. It essentially means if you have credit cards, if you've got debts that you don't really need and you're not using, pay them off. Or close it. If you have a credit card for $10,000 you're not using.
Yeah, like we spoke about.
Yeah, just close it. It will help you a lot more than you think.
Yeah.
It will definitely help you in increasing your borrowing capacity. The third one is, people always have this thought, I want to buy an occupied house first, or I want to, it depends, again, you speak to a buyer's agent, you speak to your bank or your lender, but sometimes buying an investment property that's very, very high rental yield, again, it comes back to my first point, which is increasing your income, can actually improve your ability to buy a house down the track. The reason behind that is if it's got high levels of rental yield, and you're taking into consideration negative gearing, it actually might be able to help you purchase your dream home a lot quicker than you think. Yeah. And it actually provides you an asset to assist you in using the equity to purchase that property.
Yeah. It's something we do a lot for our customers is like their first property or first two properties are investments when they buy their house. Because if you can get into a positive cash flow position through your properties, if your salary is 100,000, for example, and then you're making 10,000 from property one and 10,000 from property two, after repayments, then you've got 120,000 as income, and then you've got some equity as well from the properties, so you can use that as a deposit, and then you've got the rent coming in that you can add to your income, which is going to be able to help you service your house. Because when you're buying a house to live in, obviously you have no rent, so the entire loan is on your shoulders. If it's a $2,500 loan, you've got zero rent coming in, so you're paying $2,500 a month or whatever it is. So it's a bit harder to buy that dream home. And if you buy the dream home first, it really hits your income hard, which makes it hard to then purchase investment properties going down in the future.
Yeah.
But if you come through First Brick, we'll take care of you. We'll go through all that. We'll build the strategies for you and with you as well. Where I am conscious of time because Bishoy has a wedding to get to. He's got to go party somewhere. I think there's like 10 people rocking up to the wedding. I don't know what the new rules are. But thank you very much for coming on after about 6 months of asking you to come on again. So thanks for gracing us with your time.
Thank you for giving me the opportunity to have a chat with you. Enjoy having these chats with you.
Yeah.
You're very wise.
This was a good episode. It's actually our longest ever episode. We're approaching 1 hour. So hopefully you guys enjoyed it. We might have to listen to it in 2 takes or something on the way to work and on the way back.
I do apologise, guys. I do apologise.
No, it was a good episode. So it was good. A lot of value, a lot of gold. A lot of things we unpacked there. It was really, really interesting. I think it's going to bring a lot of benefit and will help a lot of people in the future. I actually wish I recorded this visually. It would have helped me to make some content in the future. But it's okay because my ribs are hurting and not because Bishoy dressed up very casually. This brings us to an end of this episode. Thank you so much for listening, everyone. If you have not already, please subscribe and also please leave a comment. Comment and reviews are the lifeblood of this podcast. It helps us stay up in the charts and it helps more people find us. You can find all our content on our social media pages, Facebook, Instagram, LinkedIn, YouTube. Every social media, we're on it. Spotify, we're on Spotify. We're on every podcast app. There's about 15 apps there. We're on all of them. You can find us. And Pass the Pod movement continues. And if you don't know what Pass the Pod movement is, you know one person that you think would be interested in this podcast and you tell them about the podcast and you're passing the pod on to them, and then they will continue to do so, and we'll grow a huge community. We'll get some solid questions in and this will become something great. So Pass the Pod. Thank you for listening. If you do have any questions or if you have topic ideas or if you need to get in touch with Bishoy, we'll put his contact details up. But if you need anything, send us an email at hello@firstbrick.com.au or find us on social media and send us a message. Thank you so much. Bishoy, anything else to say?
No, everyone stay safe, 1.5 meter distance, wash your hands, the rest of them, and don't think that your dreams are not close to where you can achieve them. You can definitely achieve them, guys. So, and thanks for taking that time to hear me.
Some wise words there from Bishoy. So thank you all. Buying property is our passion. Helping you do it is our mission. Ciao.